Thank you for joining today. My name is Calvin Goforth. I'm CEO of VIC Technology Venture Development and also co-manager, along with my colleague, Michael Erdinger of the VIC Investor Network. Michael will be joining us at the end of the presentation to moderate the Q&A. Please note that you can submit Q&A at any time. You don't have to wait till then. We're going to answer the questions at the end of the presentation, but you can submit your questions at any time during the course of the presentation. And then at the end, Michael will go through the questions that have been asked. So today's agenda, we're going to give a very brief introduction to VIC Tech and the VIC Investor Network. Just 5 minutes or less on that, and then move on to the main topic today, which is understanding investment term sheets from both an early stage investor and early stage company perspectives. So what is VIC Tech? VIC Tech's a venture studio. We form and build companies based on promising medtech and biotech innovations. We source these technologies from top research institutions around the world. We have a team that we call our opportunity assessment team that meets weekly. That team is presently a 15-person team. It includes VIC executive team members, life science executives, some of our scientists and engineers, some MDs, and every week we go through technologies that we've identified as available for license that might be of potential interest to VIC and determine which ones we want to dive into a deep dive, rigorous due diligence process. The technologies with the highest commercial impact, the highest impact, and moderate and the best reward to risk ratio are then exclusively licensed into new companies that VIC Tech forms. We put in place the initial team, including experienced management team and product development team. The inventors of the technology, who are most often professors at universities where the technologies are developed, are invited in as equity stakeholders and co-founders and serve as in technical advisory roles in the companies. VIC Tech and the VIC Investor Network co-invest to place the founding investment needed to launch each of these new companies. Our mission is to bring world-changing medical innovation to market. So we have companies in the medical device, therapeutics, and diagnostic space. We also have some companies related to life science in the analytical, instrumentation, and bioprocessing material space. Members of the VIC Investor Network really have a mitigated risk through partnering with VIC in these high return opportunity companies. Since inception of the network in 2013, there's been 40 investments placed. And across all those investments, there's an outstanding 38% IRR that's based on a combination of outside investor follow-on share prices and actual realized exit share prices. The network is open to accredited investors only. If you're not familiar with that term, it simply means investors who have an annual net income of $200,000 or more, or $300,000 or more in combination with spouse, or they have a net worth of $1 million, either individually or in combination with spouse. There is a $30K minimum investment commitment to join the network, but those investments can be spread in as little as 5K increments, so the $30,000 can be spread across up to 6 companies. There's no management fees extracted. There's no membership fee to be in the network. 100% of the members' investment gets placed in the invested company. Each investment is held in a separate special purpose vehicle holding company that is dedicated to that one single investment round, and it just has zero operations and holds the investment until there's an exit. VIC pays the minor cost of setting up and maintaining that special purpose vehicle holding company. So there's no fees charged to the investors for that. Okay, now on to the main topic for today, which is, again, understanding investment term sheets from both early stage investor and company perspectives. Let's first talk about the types of financing structures that you see in these type of companies, these venture capital stage companies. There's three primary types. There's priced equity, there's convertible equity, and there's venture debt. The priced equity simply means directly purchasing stock in the company for cash at an agreed upon price. That's the typically, so it's going to be preferred stock, and that's the typical financing structure. Sometimes you'll see convertible equity, which is convertible equity is debt with an interest rate and maturity date. But rather than debt that's going to be paid back in cash, it's intended to be converted into stock upon a qualified financing. So and a qualified financing means a pre-specified financing round that's expected to come later. Within the convertible equity category, there's two primary formats you see. There's conventional convertible notes, and there's a Y Combinator creation called SAFE, which stands for Simplified Agreement for Future Equity. There are some other forms of convertible equity, but those are the two primary ones you see out there. And we'll spend a little bit of time on the comparison of that. Third category is venture debt, which is going to be pretty rare in early stage startups. You're not going to be eligible for venture debt unless they think you have the cash flow to support paying it back. But they will take debt at a much earlier stage in a company than a commercial lender. So venture debt is high interest rate debt that includes some features providing more upside to the lender to compensate for the greater risk. Typically that higher upside is via stock warrants. And that's all we'll say about venture debt today, since again, it doesn't typically apply to early stage companies. But let's talk for a minute about priced versus convertible equity. Priced rounds are really typically a better choice, except for small bridge rounds to a next larger round, where that next larger round is relatively assured. There are however, some advantages to convertible equity. First, it's less complicated and there are fewer terms to negotiate. There's lower legal costs associated with a convertible equity round. And there's typically not a requirement to have a lead investor lined up to do a convertible equity round. But there are disadvantages for investors as well. First of all, there can be a misalignment because there is no valuation set. It's usually a discount to the future round valuation. There can be a misalignment between investors and current stakeholders on price. Furthermore, if that qualified financing event does not happen in the time frame before the maturity of the note, then those notes are typically going to be asked to get extended. And usually they're asked to be extended with little additional upside for the investors beyond the accruing interest rate in those notes. Another disadvantage of convertible equity is that the protections you typically see, some of which we'll discuss in this presentation, for equity stakeholders are not typically there in convertible notes. Because the convertible note holders are not actually shareholders in the company, the preferences and protections for preferred investors are not often in the convertible notes. Another disadvantage that not everyone takes into consideration, but is actually a pretty important disadvantage, is convertible note does not start the clock for the 5-year holding period for qualified small business capital gains exclusion. So for most of these early stage investments in these venture capital stage companies, if you hold the investment for 5 years, then upon exit, 5 years or more, upon exit, there's no capital gains required to be paid. That's a great advantage for these type of investments. For the convertible note holders, however, that 5-year clock doesn't start until the notes actually converted into equity. So that's a consideration. Within the convertible note structure, convertible equities structures, comparing convertible notes versus SAFE, convertible notes start as short-term debt with interest and a specified maturity date. They're convertible into equity at a discount to a future investment round, again, normally called a qualified financing. And for that qualified financing is where the valuation of the company is established. The discount may be 15%, 20% to that next round. 15 to 20% is what we see commonly. There may be a valuation cap specified on the conversion. So for example, if the next round was at a $10 million pre-money valuation, but the convertible note holders had a $7 million conversion cap, then they would be converted at $7 million valuation, since $7 million is less than, say, a 20% discount on the 10 million. The SAFE, again, simple agreement for future equity. Like convertible notes, SAFE agreements convert to equity upon qualified financing. Unlike convertible notes, SAFE investments have no interest rates or maturity dates. Furthermore, there's actually no requirement in a SAFE agreement that a debt is ever converted to equity. Now, it'd be pretty rare that's not, but you can conceive of instances where a company takes in SAFE investment and then actually becomes cash flow positive. It's hard to see that for a life science company, but for some forms of companies, it's possible. And then there's actually no obligation that they pay back the SAFE agreement within any time frame. So, and there's no interest rate accumulating. So that's a potential risk. SAFE agreements do offer simplicity, and they are very founder friendly, but they are not investor friendly, in my opinion. And VIC will not invest in SAFE rounds. Also, while SAFE agreements are simple, convertible notes themselves need not be complicated, and they offer better protection for early stage investors. All right, now let's talk more specifically about the term sheets, and I'm going to give you a few guiding principles from my experience, having been involved in the negotiation of numerous term sheets, both from the investor side and from the invested in company side. So I think I have a pretty good perspective on what is a good term sheet. First of all, I think this is really important, you want to keep the terms as simple as reasonably possible. So for example, rather than having preferred return multipliers, dividend structures, full ratchet anti-dilution, or other such terms, it's better to simply agree upon a lower valuation. It's better for the invested in company, and it's better for the investors than trying to reach agreement through adding a complicated return structure. You want to keep all stakeholders' interests well aligned. That avoids a lot of complications in the future, the potential for conflict within the company. So keeping things simple also does help keep stakeholders' interests well aligned. You want to set the deal structure for the early stage investors with the later stage investors in mind, and that means also for the early stage investors, if they require a complicated return structure, trying to get additional benefit for themselves, they can be assured that the much larger later stage investors are going to have that same or better preference. And in some cases, that may actually turn out to hurt the early stage investors rather than helping them like they expected. The NVCA model term sheet is a great resource. It's available at the link here, and I copied just like the first few clauses from it there on the right. But the NVCA, National Venture Capital Association model term sheet, is a great resource to look at, and it maps into the NVCA model documents, corporate documents, certificate of incorporation, stock purchase agreement, voting rights agreement, and so on. So it's all those documents are a great resource to look at, and we're going to go through some of the terms you see in the NVCA model term sheet. Of course, there's the very basic terms: how much capital is to be raised, what's the price per share, and or the pre-money valuation. For the pre-money valuation, that's typically going to include an employee option pool, and normally we see that in the range of between 10 to 20% of the total number of shares. The NVCA model term sheet does not include a minimum investment amount per investor, but we do actually commonly see that in early stage investment term sheets. The NVCA model term sheet covers a few different dividend structures. Dividends are payments made by the company to its shareholders, typically from the company's profits or retained earnings. And the NVCA model term sheet includes three possible dividend structures to choose from. One would be dividends that are paid on an as converted basis, when as and if paid to common stocks. That means basically all shareholders, common and preferred, are on the same basis for any dividends that the company may decide to issue. The preferred stock is just dividends just calculated as if they were converted into common stock. That's the simplest. That's the approach we would normally take. You do sometimes see an cumulative dividend, where cumulative dividend means that there's a annual percentage dividend that goes to preferred, and if it can be either paid in cash or accrued until there's a future liquidity event, and then it's paid out to the preferred before the balance of the proceeds are distributed. You can also have a non-cumulative dividend paid to preferred when and if declared by the company's board. Those are the three possible structures from which you can choose from the NVCA model term sheet. It'd be really unusual for a startup to actually pay cash dividends. Of course, cash is precious, so any early stage company is going to be really holding on to their cash. You will sometimes see cumulative dividends specified which then again they're going to accumulate to be paid later. Doing so does put time pressure on the founders, but can really end up misaligning interests of the various parties. So we really prefer keeping term sheets simple and ensuring all parties' interests are aligned, and would choose option one out of the three alternatives the NVCA offers. NVCA model term sheet also offers some different liquidation preference structures. There's actually three possible liquidation structures in the model to be paid in the event of any winding up or sale of the company. The first is what's called non-participating preferred, and that means you first pay some multiplier. Typically it's going to be 1x times the original purchase price on each share of preferred, or if greater, the pro rata ownership percentage of the exit event on an as converted basis. So what this means is if there's an exit that's large enough that it would pay back on a percentage ownership basis more than the original purchase price, then everything's calculated on a pro rata ownership basis. Although there could be a return multiplier, meaning at first you have to pay 2x, or there has to be a pro rata that's greater than 2x to do it. But anyways, basically that's how non-participating preferred works, and I'll give an example on the next slide. The second option is what's called participating preferred, where you first pay back the original purchase price, and then everything's calculated, or some multiple of the original purchase price, and then everything is calculated on an as converted basis. Third structure is kind of an in-between, where there's a cap on the preferred participation rights. 1x non-participating preferred is the norm. It's the simplest. It keeps all interests aligned, and so that's what we would always recommend. And actually, in addition to misaligning incentives, participating preferred can in some cases actually lead to lower returns for the early stage investors. That may seem counterintuitive, because after all, for participating preferred, the investors first get their purchase price back, and then it's pro rata. but you have to account for the fact that there's likely to be have been larger shareholders, larger investors coming in afterwards. And so let me give an example of a participating versus non-participating preferred exit. So it'd just be a very simplified example, but let's say there's a new company that's established with a $250,000 seed investment at a $500,000 pre-money valuation. That means that the seed investors will own 33.3% of the company. 250,000 divided by the post-money valuation is 750K, where post-money is simply the 250K cash added on top of the 500K pre-money. Now let's say there's a Series A investment, $5 million investment later on at a $5 million pre-money valuation. That means the Series A is going to own 50%, $5 million out of a $10 million post-money, and the seed investors' ownership is going to get diluted by half. So the seed investors would now own 16.7%. And finally, let's say that in this hypothetical example that the NewCo, no longer a NewCo, but is sold post-Series A for $15 million. So looking at non-participating preferred, the seed investors are going to get their pro rata percentage for a 1x non-participating preferred. They're going to get their pro rata percentage, 16.7% of $15 million, which would be $2.5 million. Obviously, that's a lot more, 10x more than their $250,000 original investment. So that's what they'll get. Similarly, the 50% of $15 million is greater than the Series A $5 million investment. So they'll get a $7.5 million participation in the exit. For participating preferred, first the $5 million Series A plus the $250,000 seed investment is paid back, and then it's pro rata for the remaining $9.75 million. So the seed investors are going to receive $250,000 plus then 16.7% of the $9.75 million, which equals $1.88 million, which, as you can see, is less than they would have received in the case of non-participating preferred. Conversely, the Series A investors will do better. Series A investors will receive $5 million plus 50% of the $9.75 million. So they'll get a $9.88 million instead of a $7.5 million. Let's look at the same example, except instead of a $15 million exit, it's an $8 million exit. In that case, for non-participating preferred, 50% of $8 million is only $4 million. So the Series A would instead get their original investment back. So they'll get $5 million. 16.7% of the remaining $3 million is greater than the $250,000 original investment for the seed investors. So they'll get they'll get the 16.7 of $3 million, which would be $500K. For the participating preferred, the $5.2 million total investments return, and then it's pro rata for the $2.75 million. In both cases, in this example, where it's actually a down round, or the sale is at a lower valuation than the previous round, then the seed investors and the Series A would actually do better with a participating preferred. All right, some of the other important terms in the MVCA model term sheet are voting rights. So, you know, for example, you'll see in the term sheet the series blank, meaning seed, Series A, Series B, whichever the current series is, as a class shall be entitled to elect X number of members of the board. Now, that board seat may or may not be offered, you know, depending on the size of the round, the mix of investors in the round. Do they already have board representation, the current size of the board, and other factors. But one thing that is very important for investors is they do have one or more board members with extremely well-aligned interests. That's another example of one of the advantages for VIC Investor Network members co-investing with VicTech on the same terms. VicTech, as both an investor and the largest founding shareholder, always has substantial voice in the company, is always there to protect the interests of its VIC Investor Network co-investors. There are various protective provisions that are defined. So you'll, in the model term sheet, you'll see that a section that starts with the company will not, without the written consent of the holders of at least blank percent, so maybe 60% of the company's series blank preferred, amend or change any of the following. So they can't, or basically they need approval to do any of the following. So you can't vote to sell the company or liquidate the company without the approval of this round of investors. You can't change the rules by modifying the certificate of incorporation or bylaws. You can't create another equity round on senior two or on parity with the current round without approval of these investors. You can't purchase or redeem or pay any dividend of capital stock prior to doing so for the current investors, and you can't create or authorize debt beyond a certain amount, other than simple things like equipment leases or bank lines of credit. You can't create a subsidiary company that is other than one that is wholly owned by the mother company. That's to make sure that they don't nobody avoids kind of the rules of the current company by creating a separate subsidiary that has a different ownership structure and can benefit different parties in different ways. And you can't increase or decrease the size of the board of directors. You might note that there's square brackets here. This is a copy directly from the NVCA model. Square brackets normally mean these terms are more optional, but we actually, I think, that's actually a good term to include because the company, of course, is controlled by its board of directors. So increasing the size or changing the composition of the board will directly impact control of the company. So all these provisions in the MVCA model are reasonable for both the investors and the other stakeholders. I don't think you normally are going to want to add a bunch of terms to that. Having reasonable protective provisions for the early stage investors helps simplify the negotiations and process with later round investors. If you add a bunch of additional stuff, it can get complicated. There are some different anti-dilution clauses available in the model term sheet. Anti-dilution provides an adjustment in case of a lower future round share price, and there's 3 alternatives considered in the NVCA model. First, there's what's called broad-based weighted average. That's a formula-based adjustment to the share conversion price. It doesn't fully claw back everything in the event of a future down round, but it does soften the blow for the earlier investors, and it's a standard formula on which that's calculated. A second option is what's called full ratchet conversion, where it's the calculation of the conversion of shares is as if the investment had been made at the new down round share price. The third is having no anti-dilution protection whatsoever. Alternative 1, weighted average, is typical and it's reasonable really for all stakeholders. Full ratchet today is uncommon and it's very unfriendly to the common shareholders. Alternative 3 is fairly common and it's the simplest, but having some anti-dilution protection is a reasonable request from the investors. Regarding exits and liquidity, you'll see clauses in the model term sheet like drag along provisions that basically means if a majority of both the preferred and common share stockholders want to sell the company, all the other stockholders can be dragged along in the sale. So that keeps a small minority from being able to block a sale. Again, that's not typically going to be an issue if you've got all stakeholders' interests are aligned. It can become an issue though if you haven't done a good job on keeping stakeholders' interests aligned. You may have a sale of company, let's say it's a $50 million sale that's of a great return for the later stage investors, a poor return for early stage investors, and not a return at all for the common shareholders if you haven't done a good job keeping interests aligned. Another thing, registration rights address what happens with an investor stock in the event of an IPO. Don't really need those in early round investments. Those can always be added in the larger later rounds. Redemption rights allow investors to force the company to redeem their shares at cost, or perhaps with a small guaranteed return. But in practice, redemption rights are not often used, and we don't recommend including them. So to summarize, term sheets should try to align the interests of all stakeholders to the degree reasonably possible. You want to keep it simple. We recommend working towards an agreed upon, and if necessary, lower valuation is typically a better approach than a complex preference structure, a better approach both for the investors and the current stakeholders. You want to be fair and balanced with the interests of all stakeholders, including the common shareholders in mind. And finally, the MBCA model documents, including their model term sheet, are a great reference source for all of this. And with that, we're going to open it up for questions. My colleague Michael Ardinger will moderate the Q&A.
The question is, what is the typical range of the check size for these investments? And this question was asked very early in the presentation, so I'm assuming that it's regarding the amount of funding that's invested in newly formed startup companies.
Right. So that is, that can vary widely. I can tell you for the companies that VIC forms, the initial founding investments pretty modest. It's up to $500,000, which for these type of companies, which need millions or many millions of dollars to go all the way through commercialization, that's a modest investment. But in every case, we've been able to take that initial founding investment up to $500,000 and advance the company and position it for substantial follow-on rounds from outside investors, with our own investors continuing to participate as desired in those follow-on rounds. But in terms of what's typical out there, it's all over the place.
And could you touch on, an extension to that question? Can you touch on, Calvin, the specifics of the VIC Investor Network members, their initial investment as founder? I'm asking this question specifically based on my knowledge. The founder members, what their role is, what the format of their investment is versus the standard members, and maybe differentiate between those two groups.
Sure. So as Michael alluded to, there's two membership classes within the VIC Investor Network. There's what we call the Founders Group members, and then what we call standard members. Founders Group members participate in the founding round of every new company, and they'll participate at either a $5,000 or $10,000 per slot held in the network level. So if they hold one of the 50 slots available in the Founders Group, which are presently, if they hold one of the 50 slots and it's a $250,000 investment, then they would put in $5,000. If it's a $500,000 founding investment, they'd put in $10,000. VIC holds 10 of those slots, so VIC puts in 10x that, and some of the other Founders Group members hold multiple slots as well. For standard members, they can invest in any round after the follow-on round. They have the Founders Group, doesn't get to pick and choose, but they come in at an extremely attractive valuation and have the highest upside. The standard members can participate in any follow-on round, and they can pick and choose. So they can choose to have some of their investments at very early stage, some in mid stage, some at later stage. So they have an opportunity for to have a diversification, not just by number of companies and sector, but also by stage of development. Whereas the Founders Group are always going at the earliest stage, but have the highest upside.
Fantastic, thank you. And then after making the $30,000 investment commitment, can members continue to invest beyond that?
Yes, and that's very common. We often have members invest much more than the minimum. The $30,000 minimum is required, required to join the network, meaning you have to agree via commitment letter to invest at least $30,000, again, in as small as $5,000 increments. But many members invest more than that. And also, I'll say that the Founders Group members, they're committing to invest $30,000 in founding investments, but they can also invest more than that by participating in later or in follow-on investment rounds.
I've got two of the same question, essentially. Will the presentation deck be available?
Yes, we can certainly make the presentation deck available. If you don't mind, if you would like a copy, please send it to me at calvin.goforth@victech.com, the request, and I'll be glad to send you a copy.
And then the last question I have is, what are the advantages, disadvantages to making early versus later investments in these life science portfolio companies?
Well, personally, I think it's a great idea to have some diversification and have some of each. Obviously, the earlier stage investments have higher upside. The later stage investments have a potential faster return of capital. In many cases, later stage investments are simply not accessible to individual investors, but through our VIC Investor Network, those later stage investments are accessible. And I recommend to all standard members to diversify, including some early, some mid, and some late. Founders Group don't have the option of diversification, but they have another big advantage, which is they invest at such an attractive valuation that their upside is extremely high.
Okay, that's it for the questions that I've received. If there are any last minute questions from the attendees, please use the Q&A function to post those. Let me see, I think one more came in. Oh, here's a question, just came through. What percent of a company should you shoot to obtain with a $250,000 to $500,000 investment? I am sure it varies widely, but touch on the middle part of the bell curve. I don't know if you understand that question, Calvin.
Yeah, I think I do. So it depends what stage you're talking about. It's what stage of company you're talking about. A newly or relatively newly formed startup, they may have a valuation in the $1 million to $2 million range for these type of life science startups. Although for the VIC Investor Network Founders Group members, it's much lower than that. I'm just talking about what's typical out there. So if you had a $1 million pre-money valuation, they made a $250,000 investment, that would be 20% ownership. 250,000 divided by 1.25 million post money. Series A, you're gonna probably there's a lot of variation, but it could be anywhere from $3 million to $15 million type of valuation. I mean, there's just huge variation. Just depends how far the company's progressed, and for example, one of our companies recently did a Series A led by a large strategic. The Series A was led by a large life science company, and it went in at a $12 million pre-money valuation, but that would be on the high end of what we normally see for the Series A. So it's, again, there's a lot of variation. It depends on the stage of development of the company.
Thank you, Calvin. If I could continue that thought, and this is something that I'm asking. Maybe it would make sense to compare and contrast a venture studio, a venture creation firm like Vic Tech, which creates the company from scratch, has the formational, first investment in standing up that company, with, say, an angel network, which is seeing companies that come in to pitch to the angel network, and maybe making a comparable $250,000 to $500,000 investment. But what would they, at the end of that investment, own as a percentage of the company? Would they have board representation? Would they have close oversight of their investment? And how that contrasts with the VIC approach?
Yeah, so I mean, obviously I'm a little biased, but I think there's tremendous advantages to the venture studio model. First of all, Vic has done extreme due diligence on every opportunity. So there's no kind of hidden warts like you so many times after, investments placed. And then, it's hard for angel groups to do the level of due diligence because angel groups, the members aren't getting paid. Who's going to spend all the time to do due diligence for the group? Now different angel groups, some do a lot better job than others on that, but for VIC companies, there's no hidden warts. We've been there from the beginning of the company. We did extreme due diligence on the technology and the front end. We know everything about the company. We're co-investing on the same terms as the VIC Investor Network members. That's a big deal. Furthermore, we're ensuring that the valuations, not just are we offering great valuations for the VIC Investor Network members on the founding capital rounds, and one of the reasons we can do that is as a venture studio model. We also have common stock, so we have upside in addition to our preferred investment. So what that means is we're able to offer much greater or much better valuations. For $250,000 founding investment, it goes in at a $500K pre-money. And so the $250,000 founding investment gets 33% ownership stake in the company. And for the type of companies, the type of teams we put in place, the type of technologies, that is just really kind of an unheard of good valuation. And then even in the follow-on rounds, Vic won't bring it to the Vic Investor Network unless it's a good valuation that Vic is itself going to co-invest with. So you've always got this insider knowledge, whereas angel groups, they're gonna take their shots. They've got to figure out who's going to do the due diligence, who's going to oversee the investment. Are they going to be able to participate in follow-on rounds? Will they have board representation? They may be too small of an investor to have a board seat, so they don't really have someone there protecting their interests. There's a lot of advantages to the venture studio model, both for the investors in the venture studio, but also for the co-investors, in our case for the Vic Investor Network.
Fantastic. Well, that ends the questions that I have, Calvin. Just one request to repeat your email address, please.
Yeah, it's Calvin, CALVIN@victech.com. And I actually, Michael, it looks like there were a couple of questions added. Did you get those?
Oh, yes, thank you. Just saw those. Let me read through these very quickly. Can you give a brief example or two of a scenario where valuation was disputed at Series A stage or an earlier stage where non-VIC investors invested, and factors/strategies that resolved it?
So it was disputed. You mean, I guess it's a disagreement between what the current stakeholders in the company think the company is worth and what potential investors in the new round think it's worth, I guess.
That's my interpretation. Yes.
Yes. So that's a good question. in some cases it's simply not possible, and you move on to the next investor from the company point of view, or from the investor point of view, you move on to the next company. You can, one of the reasons convertible notes get used is you don't necessarily have to agree on a valuation. So you can use a convertible note for the situation where a valuation can't be established. And then it's just a discount to the next round of investment, which some larger investors are going to establish the valuation. I don't recommend that approach unless two things. One is it's a relatively small bridge round, and secondly, there's relatively assured success in that follow-on financing. But that is one approach that you see out there, not uncommonly. Another approach is, some of the preference structures that we talked about, a guaranteed liquidation preference. The only time that we've ever used that is, we did have one company that got into some trouble, meaning it had a failed study, animal study, really needed some money desperately to understand what happened in that study. And so it offered, so it went back to its previous investors and said, but hey, to compensate for the additional risk, we'll do a 2x liquidation preference on this next round. But we tend to avoid those complications in the structure where possible, and really work towards achieving a mutually agreed on valuation. And in my perspective, it's often better to go ahead and agree to a lower valuation than to put in complicated preference structures.
Okay, and I promise this is the last question, Calvin. How does VIC fund its operating expenses?
Yeah, so we allocate our team members to the companies. So, for example, Michael serves as interim CEO for 2 of our portfolio companies. I serve as interim CEO for one of them. We allocate all our team members at cost. We don't try to make any money, from our services. We just try to cover our costs. And in fact, we do lose some money from operating expenses each year, but that's a tiny amount compared to the equity value growth that we see, and from our holdings in these companies. But our team members focus on the early stages of the company. So we put people like Michael and myself, who both had experience bringing early stage technologies all the way to commercialization exit, raised many millions of dollars in capital along the way. We're focused on getting the companies launched and getting some traction. And then once you've got some traction, then recruiting in permanent management to take over. It's hard to get the type of people you want, the other experienced people. They've got options until you've got some traction in the company. So our team's really specialized in getting that early traction, and then we recruit in permanent management, and our team members move on to the next opportunity. But that's the way we fund our operations, including all of our support staff. We offer our companies complete back office support, HR, accounting, help with legal setup and scientific engineering support and more, and we charge all that out at cost. We don't try to make any money, but it's a very flexible, very cost-effective resource for the companies, while covering our costs as the venture studio.
Perfect. Thank you so much, Calvin. And if there are any other questions from the attendees, you've got Calvin's email address, so please feel free to reach out to him.
All right. Thanks, everyone. Appreciate so much you joining.
Thank you, everyone. Take care.